Get this going here. I give it a minute while people come into the room. I think most of you know the general format. If you guys want to give me some stuff you want me to cover, I'd be happy to try and incorporate a lot of it into the mix here. I'm just writing it down. A lot of stuff today, huh? Yeah. Yes. All right. I think Baba. All right. I think I have a good amount of stuff here. There's some other stuff we need to talk about as well. All right. So let's begin. I think I'm just looking at something quickly. Yeah, all right, so let's start. So today we got a little bit of a pullback in the market. The day started out with some economic data, which I don't know if it got enough attention, but we had the Philly Fed today, which was a terrible number. A lot of the spending now, we do have some interesting information. A lot of the spending has been coming from data and networking security, and basically compliance and plant security. So companies are spending a lot on their security, their data, which has been, I guess, would be good for the cohort of like the Palo Altos, the FireEyes, the cybersecurity type of stocks. But the manufacturer, the Philly Fed, the growth is really rather weak. This just confirms the thesis of what's been going on for a while. I'll actually, if anyone's curious, I'll post in the description in this broadcast, on the rebroadcast that I'm going to post on YouTube, I'll post the Philly Fed read. I don't really want to get too into it because it's a little bit nuanced and I don't want to waste time. I'll put you guys to sleep with it, but it wasn't good. So I was trying to think of something while I was preparing for this video. I wasn't really preparing all that much, but I was thinking about, I often think about what I want to say. And I was trying to come up with a way of expressing how bad the jobs numbers really are. I've been talking about this for a while, and I think a lot of people get very caught up in that 4.95% headline number, and they don't really realize that the internals, the quality of those jobs are really crappy. I've talked about us being a nation basically of waiters, waitresses, bartenders, and carnival ride operators. That was something from about a year ago or so in a Fed release that it just caught my eye, and I kind of have been discussing it. So the best thing I could muster, and I think this is actually quite good, if you think about a stock that was like once expensive and is now like single digits, and then they reverse split the stock like 10-1, that's sort of like what is happening now with the jobs numbers. It's sort of like a stock that was like 100 that went to like 40 cents, and now they reverse split it and it's like $4 or something. And it's, wow, a big deal. So that's really my new analogy to what's been going on in the jobs market. The companies that have been really minting are the ones that people have no choice onto spending. If you take a look, healthcare today was kind of leading the charge. United Health is pulling out of the Obamacare network. That I've often been very vocally critical of Obamacare and the Obamacare tax, and those chickens are finally coming home to roost with companies pulling out. More companies pull out. United Health being the biggest, although I believe they only have like 6% share in the entire network. They will lead the way for other companies to either raise prices significantly as there's less competition, there's more pricing power, or more companies will just drop out. That is, again, simple supply and demand. A lot of people don't really seem to understand that. They're probably the same people who don't understand the inverse relationship between yield and price. So I think that covers up a little bit of the macro. We haven't had, I've gone, for those of you who haven't seen in a while, I always assume everyone watches all of the broadcasts, but apparently people miss one once in a while. It happens. I'm going to start taking attendance, though. So the GDP numbers I've talked about, the Atlanta Fed, they are abysmal. Everyone gets really excited when they jump like 0.4%. The problem is it's like 0.4% to like 0.8%. The growth is really not coming in well. ISMs, there had been a little bit of a bump in a couple of readings ago that I thought took the first potential of a first half recession off the table. Durable goods, I talked about there had been a bit of a bump, and then they since have come back a bit. People basically, after 10 straight months, bought a couple of toasters. I guess they, eventually, you gotta eat, right? So that's the story with the macro scene. It's quite an ugly picture. You had Draghi this morning. I think a lot of people took this as just an opportunity to kind of book some profits and just sell the news a little bit. With regard to like the dollar and the euro, I've talked about the dollar. I'm just going to pull up this chart here. Unfortunately, I gotta get some better technology where you guys can kind of see what I'm seeing on the periscopes, but I'll keep it simple, stupid. I've drawn in a regression line on the DX chart. I'll show this in the weekend review because this is way too important to ignore. Every time we sort of hit that regression line, we get a bounce, and we've just been kind of riding it down. So I think the trend for the dollar is still looking lower, but it's not going to be a straight line. I think this is really you're going to hear what I have to say about SPY commentary, and I think that'll explain to you where my head is. I've talked about the UUP. A lot of people like ETFs, so I'll play. I've talked about a range. Anything above 25.68 is a little unsustainable to the upside. Anything below 24.47 becomes a little unsustainable to the downside. We've had a few look belows here and fail, and then today we basically closed at kind of just at the backside of an older regression line in that chart. It to me looks like there could be some more risk to the upside in the dollar, which of course will cause some trouble with regard to the markets and maybe with oil. However, and that's a big however, I am in the camp that I think oil is going possibly even significantly higher. If you look at today's chart, we had a bit of a pullback, but it was really more of just a doji, and we still have held above the 42.49 breakout. So as long as we're above there and really above the body of the breakout of the prior day, which was yesterday, it still is kind of okay. That was confirmed to me by ExxonMobil. That's sort of my bellwether. When you want to talk, when you think oil, think Exxon. Exxon was actually positive for a lot of the day, and it closed like down a penny. If oil was really going to be getting the smackdown, I think Exxon would have been getting the smackdown potentially a lot worse. Oh, I'm getting glare from the background. Let me try and adjust. There we go. So I think oil, I think it's not going to be a straight shot up to 49s, but that's where I think we're headed eventually. Yes, there could be pullbacks and stuff, but the last major pullback has held the 20-day moving average, and we for the most part had an inverse head and shoulders breakout pattern that is like just broke yesterday. So it could be a failed breakout. It's possible, but my theory is that I think oil is going to go higher, and I'll stick to that for now. A lot of people have been Johnny-come-latelys in the gold market. I've been long via SLV for a while. I bought it around the 14s. It's up in the 16s, which is nice. Very nice. I like you. This to me looks like a really nice rounded bottom. We like those. So anything in my view above this like 1560 down to like 1545, there's a nice honey of a gap there. To me, I could see it pulling back. I understand, but the chart is making higher lows with higher highs. That's what I like to see. With regard to gold, it's just kind of consolidating. It's a little choppy. It broke out. It got into some reference resistance. My hesitance, if you're first looking to foray into gold here, number one, it's above the 20 and above the 50, so if you're long, you can stick with it against those levels. it's sort of the argument I made with Win yesterday. I don't know if many of you heard me. I was on as a guest on the Shadow Trader broadcast, the regular one, with my buddy Brad. Quite a long hitter, Brad. So we were talking about the Win and saying that you're a long way from Kansas, Toto, sort of with the fib retracements, and the same thing with gold. You basically bottomed at 123 and topped at 122.37, and now you're kind of just in the middle of this chop range. The problem is like the 50% fib is 111.30. So you're talking about $11 down from the top. And the one that I love to buy with gold, it's very responsive to the 61.8, is down at 108.69, and that is just below the 200 MA and a major kind of other volume distribution. So I'd be a buyer if we did get down there, like if there's some kind of dollar rally. I don't necessarily know that that's going to be the case, but let's watch the 50 MA. That has been support a few times. You would really need a close below the 50 and then a confirmation day below it the following for my view with gold to start getting really bearish. And I don't want to get into platinum, but someone had posted the other day that platinum is looking a little bit more bullish than not. Let's just talk about the broad tape, and then we'll get into some individual stocks, because that's really what's going to matter here. The correlation with the market becomes higher, obviously, as the market goes lower, and kind of you get into like this actualizer phase. I don't know if you're into like marketing dynamics or whatever, but there's like different categories of personality, and actualizer is another one of them. It's sort of like, when things are going well, you can make these kind of existential arguments about stocks. I mean, honestly, when you're in a bull market, for the most part, everyone thinks they're a genius because they pick a stock, it's going up. But I mean, like all stocks, when the market goes up, for the most part, all stocks go up. And this is a general rule. I'm not talking about like the Valiance and the dumpster fire that was Sun Edison. But, and when the market goes down, stocks go down. I mean, it's sort of trading along the line of least resistance. The trend, the trend is your friend. So the good news, there's good news and there's a little bit of bad news with regard to SPY. Yes, rising tide lifts all ships, correct. And loose lips from the Fed sink ships. We'll keep that as a saying also. So with regard to SPY, we've been up quite a bit. I mean, the market basically bottomed in the 181s, and we basically got very close to, basically right to my target. I've been talking about this 210 to 211 area. We topped at 210.92. Today's close, interestingly enough, held a key area of support. We did have poor lows, which probably will be repaired tomorrow, given the weakness in some of the earnings stocks, which I'm going to get to. I have them all written down, and how to trade them and the move. We're going to talk about them all in a little bit. Don't worry, this is going to be a really good broadcast, I think. So we held the. I'll say this: as long as the pullback can hold 208.97 to 207.84, these are some are proprietary. This is a blend of proprietary levels. I think that the market is sort of like okay. And I'd be willing to stipulate that if it gets a little bit further, even down to 206.76, it's still kind of like within tolerance. I wouldn't be surprised, believe it or not, to even see the market fill the gap to the 205.92. That's really where this kind of big move got going from. We did, however, break a downtrend line in SPY, which is quite a long-term downtrend. This really got started back in July of last year, I want to say. So, we've had a lot of sideways action, some significant breaks down, and then moves back up. My take is that we just got into a very key reference level of the 210 to 211 area, and I think a lot of people who were long from those levels prior decided to book some profits. I think that they're big round targets that people decided to use, and one that people won't talk about, particularly on Twitter, because they don't understand how institutions and risk management works. But at some point you may get a tap on your shoulder from your risk manager on the floor and say, okay, you're a little too long, or you've a certain position has exceeded the position limit that you have. And it wouldn't surprise me as if they told them to start taking down their VAR, which is value at risk of a total portfolio at those key levels. I know this because I do. I've been trading for a while. So that is that's my take on what happened today. I'll tell you this, a lot of bears, I have a lot of people on the stream who I follow, and a lot of people follow me, and I have a lot of interaction with people. And I'll tell you, today was not nearly as bearish as you might think it was. That I know because of internals. Let's start out with the bear thesis first, and then we'll talk about why it might not be so bearish. So the bear thesis is this, yesterday we had a bit of a topping tail. It was a bit of a doji, believe it or not. I know some people were asking if it was a shooting star today or one of those, I guess, evening stars or what have you. My answer to that is it wasn't, because you had range overlap with the prior day. Though those shooting stars and the island reversals tend to be on gaps above the prior day range with like small dojis. Sometimes it lasts a day or two, and then you have a gap down below the low of day there, and then that signals the reversal pattern. Today also had overlap. Like I said, you closed above an old a way old reference high. Just barely. If you look at the close, the 208.97, we closed there to the penny. I know we're down a little after hours on Microsoft, Google, Visa, Starbucks. I know about this, Mr. Goss, but I'll tell you, the way they sold it off today, and a lot of this was a lot of chop early, and it sold off a little bit more late in the day. This didn't feel like heavy institutional dumping to me. I knew that by the breath. The New York Stock Exchange, the NYSE breath, was only 2.2 to 1 negative, and the NASDAQ was 1.14 to 1 negative. And today, I guess you could say, was a bit of a trending day. Trending days don't really happen on those type of internals. The vestibule for a trending day is typically 5 to 1 or 8 to 1 negative. This reminded me, today felt a lot like if you went back to that 10-day consolidation period starting on 330, lasting through 412. Those days that sold off, particularly, I'll give you the dates, 4.7, 4.8, and 4.9, where we kind of opened on the highs and closed on the lows. This was that exact feeling, that unsure market with people who bought late and were nervous, and who, were late to the party. They bought late. They wanted to take some profits. They saw the consolidation, and this was like that feeling, selling off on some of those days. Believe it or not, sold off on positive internals. Today the NASDAQ actually was a little green for a while, even into the selling. So this wasn't like, whack-a-mole selling. This was very tame. Often, I will tell you this, often inflection points do start off as tame and they get nasty once people really realize them. I don't assume that is necessarily the case here. This could just be we broke out of the 10-day range. Maybe it wants to come back and retest there. Like I said, that's the 206.76 plus. The true breakout of that day, of that range, was over 207.14. I'll stick with the 206.76 just because that is a very key level on my charts from going into the Wayback Machine. So it wouldn't surprise me to even, believe it or not, see that bit of a retest. You'll have everybody freaked out there and they won't realize that it's just a retest to the breakout. That's what I think happened today. We'll see what happens tomorrow. All right, so here's the story with the earnings gaps. We all know that we have a little bit of blood being shed after hours here in Microsoft, Google, Visa, and Starbucks. Actually, you know what? I just want to hit one stock up. I forgot to take it off today with Skechers. I had some short puts, and I realized I forgot to close them. And good, the stock's up. It usually works out that way for me. So, all right, take that off my list. Anyway, all right, so that worked out. Anyway, let's talk about the ones that really matter. Skechers isn't going to make or break the tape. Microsoft. So that actually was a bullish pattern, believe it or not. I was super tempted to play this long for earnings, and I'd have been wrong. Just because it got the basically it got a double top, backed off a little. The pattern looks like it wants to go to the old all-time high, close to 60. I think what held me back was Intel. Microsoft and Intel, and I'll say this, I wasn't a huge fan of Microsoft for a long time. I really felt that they had lost their innovation, although they're doing a lot better with the cloud. The pattern to me looked like it might want to have a bit of a pop. You have a 50-day moving average around the 53s. I'm just looking where it's trading now. It's trading around the 53s. So, and you have a 50 and 100-day there. So it might actually, believe it or not, get bought off the open. So I would even, believe it or not, with 1 day to expiration tomorrow, or no days, 0 days to expiration, if it opens up right at the 50, I'd be interested in right or right out selling some out of the money puts that expire tomorrow. That to me would be an amazing trade. The expected move in Microsoft is $2.28. Anything inside that move could have a gap fill. If it becomes outside, meaning the move is outsized, larger than that move down, I would think that that gap might not fill, and you might have a gap and go with some continuation, particularly if it's below, that 50 and 100-day moving average. Key to playing gaps on up or down, and this could save your life, believe it or not. It has saved mine on many occasions. It doesn't mean you won't have a loss, or you might be caught on the wrong side or whatever if you're already in the trade, but it will prevent you from meltdowns. So I often like to use the opening 5 or 15-minute low and see where that is in reference to the overnight low or the after-hours low. Some terminology I sometimes use on the stream is AF, which means AH, after hours, and then ON is overnight, and then PM is pre-market. It really all doesn't matter. It just is what it is. It just means non-regular trading hour session, RTH. So I like to see where the RTH low of day is in relation to the after hours low of day. Now, if Microsoft is lower pre-market and then regular trading hours, the low is higher, over that opening 5 or 15-minute bar is a long. If you lose that 15-minute low and then you take out the low from the after hours, it's a short. The stock is likely going much, much lower. So keep those in mind. Look to see where those line up. That is really key and could save or make you good amounts of money. The same story with Google. It's that pattern was a little not as, I wouldn't say it was as bullish as Microsoft, but it was okay. The expected move was $39.64. Google, where is Google? Google. I use the L one, by the way, GOOGL, is 737. All right, so let me pull up Google. All right, that 50 MA is 746. The old gap from the last move was 752.05. Anything below there to me could be a little bit vulnerable. Maybe it wants to see the 200 around 714-ish. If you open, or it kind of can hold that 752.06-ish area, I think that the gap could fill. Google often likes to fill the gap or rally and then sell off. It's a bit of a temperamental stock. I don't really like trading Google inside of the range. I like to either short it at the channel high or buy it at the channel low. I don't really mess with it in between, and I'll stick to that. You are, however, coming off a bit of a lower high. I often get cautious with these stocks. This was the same kind of setup. I wouldn't say it was the same kind of, exactly the same setup as Netflix, why I called that a short, but this is, because this went a little too far, but it is basically that setup when you've had a big move down and a slow grind back up to earnings, and then it kind of gets the wackarooski. So that is kind of what happened here. Microsoft seems to be faring a little bit better after hours than Google. I'll tell you this, and I've said this on the, I just want to see something here. Yeah, I've said this before on Netflix. They will probably, and Facebook is even more linked to Google, will probably whack Facebook on this. I believe Facebook is taking market share from Google, and a lot of the weakness in Google could be because of Facebook. So let's keep that in mind. Facebook doesn't report for a little while. My hope, and I know this is going to sound crazy because I'm actually bullish on the stock, my hope is that they smash this stock into pieces going into the earnings. You finally get a respectable IV pop in Facebook, and then we can sell some out-of-the-money puts in that. I'm going to detail that trade a little bit. When did they report? They report on the 27th? So we have a little bit of time, which is nice. Hopefully, listen, I talked about this. Yeah, they report next Wednesday. So I probably won't be doing too many earnings trades before then. I don't always play every stock with earnings trades. I'm a little bit selective. I know a lot of people like to play them all. I don't play that way. I play the ones where I think I have a bit of an edge or I think I know something. I often don't know something, but if I think I know something, then I at least try. So my theory is this, is anything above 110.65, if you're long, you can still kind of hold it. It's not even trading below there in after hours. To see all-time highs, though, for this stock to have all-time highs in its sights, you need to be above, I think it's 112.66. Let's see. Yep, 112.65. Over that is long. So I talked about the Facebook having that false report that came out. We've been trading a little bit above there. You have a 20-day moving average around the 112.48. Looks like it's trading below there. The real key range here, though, is the 106.52 to the 112.65. That was that day with the wild report. Anything inside there is, to me, a little suspect and iffy, but if you can get and maintain back over that high, like if tomorrow opens weak and then you get back up above the 112.66 and close there, it is going to be speaking volumes to me. That's a really important level, that kind of range. When you have big emotional days, like an earnings day or a Fed day or an ECB day, that range is very important. Speaking of which, today was a ECB day. You can use today's range also if you want, if you're like immediate time frame for SPY as well. So that's Google. Look to see, like I said, if that move narrows by the open or if it stays weak. But like I said, to see the expected move is 39.64. Visa ran a lot on American Express yesterday, which had already run itself into its number. This was basically peaking above the last high. It had a little bit more room potentially to a regression line. It was trading below, believe it or I should say the progression line, not regression, the progression line. I will show you what that looks like in the weekend review video also. I better star these so that I remember to do that. I'll do all of these earnings ones. So the risk reward here to me was a little bit iffy, particularly after having been up on American Express. Is Visa still trading down? Let me see. Yeah, it's trading down a bit. That doesn't surprise me. I wouldn't be surprised to see that fill in a little bit here. It is. I wanted to say it was a head and shoulders pattern, but the right shoulder already eclipsed the head. So this could have a bit of a pullback, though, believe it or not. Let's throw a Fibonacci on this sucker. I'll do this live on air. How exciting, right? So the stock has poor highs, number one. So this could be construed as a liquidation break. What's the low here? This isn't correct. It didn't snap properly. I hate when that happens. It's really, really annoying. All right, let's take out the 38.2 because I don't use 38.2s. All right, so the 50% fib, which was really the breakout area, is 73.93, and the 61.8 is 72. That would be a pretty big, and you also have a 50 and a 200-day confluence in the 74s. Excuse me. Where are we trading here? 76. All right, 76, 77. All right, so I would be into either selling puts if there's still some juice in there tomorrow at that level early, or doing a put ratio where you buy one put higher and then sell 2 times out of the money. The expected move on Visa, like I said, was $2.74. So, yeah, I think that could be a holder. But let's see how that works. Starbucks. This I know has been coming off a bit. Yeah, this is a weird pattern. I actually, if I looked at this, you'd think that, well, all right, you did have a little bit of a lower high here. All right, so it wasn't as bullish as I thought it was here, but I didn't play it, so it doesn't really matter. This actually, to me, looked like this could have been a gap up. If I didn't see the chart and someone put a gun to my head, I would tell them not to. But I would think that this looks like it might want to go a bit higher. The gap, it's currently trading here below in the 57 area. So that is below the 50 and the 200-day, but there are some reference lows around the 56s and the 55s. I'd probably be into selling those puts, like the 55s, if there is any juice in them tomorrow. There probably won't be, is my guess. It's also a big number that I could see them pinning, and it's also the edge. No, the edge of the volume distribution is, yeah, it's in the 55, 56-ish areas. There's some hammers around there. That area, to me, I think you could probably, just for tomorrow, be a put seller into. If you want to try and do something a little bit more longer dated, you can try and play for something into the flash crash day range, which would be closer to 50. I don't really know if those options are going to have enough juice to play it in, so I'll probably be looking to sidestep Starbucks. All right, there's an earnings play out that nobody is talking about other than me, and that's why you listen to me, because you get stuff that you probably don't get from these other Cracker Jack boxes. Who, you go in and you look for the prize and you don't know what you're going to get. Norfolk Southern. This was a monster quarter for them. I have to look onto the internals because I think their shipping rate volumes were down a little bit, but they crushed it, man. They had $1.29 of earnings versus 97-cent expectations, and they beat on revenues by $2.42 billion versus $2.4 billion. The expected move was only $2.72. They are trading well above there, I believe, in after hours. Looks like in the 86s. So what is the significance of this? One is not necessarily if you want to absolutely... First of all, it's a break of the downtrend line, which is good. Although this really wasn't in so much of a downtrend. If you take from the 98.75 top and you draw to this last peak here, why is this snapping today? Yeah, you really need to get over 86.66. If it can clear there, I mean you've got a little bit of room. That's kind of a volume distribution that you're gapping up really above, which was like an 84s, 85s. So there's not that much in terms of immediate dead bodies right here. Let me take this out a little bit longer. And believe it or not, I know this is going to sound aggressive, but this could get to a hundo, or close to a hundo. That was really where the big breakdown took place. Let's see how that trades tomorrow. Bigger implications of the Norfolk Southern earnings call is that these are the transports here, right? All right, I drew a longer term downtrend from the old high here of the 117.64, and let's change that color to red. Roll that beautiful bean footage. There is a downtrend, all right, closer to 90, 91. That would be the first target. I think it can get, I don't see why it wouldn't get there. The stock is looking pretty solid. So that's where I would think it could trade to. That's my spiel with that. We talked about gold, we talked about silver, we talked about SPY and the levels, we talked about the dollar. We didn't talk about bonds, and this is a really interesting situation that we have here. So the pattern here looks like we're in pullback mode here, at least for a while in bonds. The problem for that and the benefit, it's sort of a double-sided sword here. One is if rates are too low when you go into the Fed, it's sort of I don't know how to really articulate this well here, other than to say this. markets deserve a premium multiple with interest rates when they are low. If interest rates really start to rise, and they're not really out of control here, they're basically just futzing around in range, although we do have a bit of a lower high here, 2 lower highs, and you have a swing pivot low in the 27s. That is a really key area. If you start violating the 127s and the 126s off of a lower high, you're going to start getting the rate hike talk again. And I could easily see this getting to the channel low with a 200-day MA test around 124s, where it is currently. As of now, I mean, there's really not all that much being factored in terms of rate hikes. I'm just looking at the expected move. You're still not talking about a hike till December. Now it has a 65% probability. November is 47%, so I guess that's edged up a little bit, but September is 43%. I mean, you don't get above 50% until December. That's probably when this is going to go down. Maybe they'll do the one and done like they did this year. But like I've said for a while, as long treasuries don't even need to really continue to rally that much. They just don't have to go down a lot. For the market to maintain and deserve a premium multiple, you need historically low interest rates. People keep talking about growth to GDP and earnings growth based on PE multiples, and they say, oh, you know, the GDP is weak and the global growth is weak, and you know, earnings growth is weak, and you're trading at this high PE multiple. It's unsustainable. The market has to correct or crash. That is all true, except when you factor in interest rates, and that is a big, big deal. Markets tend to peak when rates are 5 or 6%. And you have a big PE multiple. The problem is you don't have you don't have high interest rates now, but yes, you have a bit of a high PE multiple. That is the case, and you should have a high PE multiple as long as you have these historically low interest rates. So that is very key to keep an eye on. A lot of people think if TLT is rallying, that means the market should be crashing. It's the exact opposite. If TLT is crashing, then the market should be crashing. It's really that simple. It is coming down. I noticed today a lot of the bond kind of plays that I've talked about are getting swatted, like the Coca-Colas. That broke trend. That's coming in a bit. Again, that was another one a long way from Fibonacci levels. Let's see. Johnson & Johnson is at an all-time high here. That looks like it's getting a little bit toppy. What else? Let me look at some of these utilities. Con Edison getting the smackdown. NGG also smackdown. Philip Morris, not a utility, but a bond. Yeah, I mean, all of the bond proxy plays look like they're coming in a little bit. This could actually, believe it or not, be a little bit bullish, because this means that people are reallocating. Like, look at the stocks that have been rallying here. Yes, they've been pulling money out of the FANGs a little bit, and they're pulling some money now out of the safety stocks, but they're putting them into some of the financials have been rallying a bit, and also into the materials and energy stocks. So there's just a little bit of a rotation. I think it's actually good if these bond proxy stocks sell off a bit, because it's freeing up money. People, this is the risk-off trade, buying up Altria and buying up Con Edison. The risk-on trade is buying, Exxon and Norfolk Southern and late economic cycle plays. So I shouldn't say those are really more early economic cycle plays, but yeah, I mean that to me is actually is a little bit bullish. Let's get into some more of these stocks here. Apple, that was a bit of a tell this morning. We talked about this last week, that there was that kind of effery that went down on Friday, that wash down out of the Nikkei reporting, that some of these companies are it's looking like, basically that Apple was looking weak, like they might miss the quarter. It's a little concerning that you've lost a few levels. You lost the 110, you lost the 109.14, you lost 107.31. You do have a 50-day, anything below 107s, you're talking about potentially 104.48. Really the big key one here is the 102s to 103s. I could see that being the key. 103s currently are where the 50 and the 100 are getting close to crossing. You actually almost have a 50 crossing through the 100. So I think you could get a little bit of a move down there. Again, this is another one that just got a little overbought. It looked above trend. It failed. The back off was mild. You now have poor highs that have backed off. So this, to me, looks like it could be setting up for a shake and bake. The caveat is that this quarter and the next one at the end of the summer aren't historically great quarters for Apple. That doesn't start happening until the end of the year. So Apple might be a little bit of dead money for a while until kind of getting closer to the end of the summer. I know people don't want to hear that. They always want to know what they can do this instant. But yeah, I think that Apple could, maybe sell off a little bit further. We'll have to see. Yeah. I think I talked about FANG here. We did. We talked about Apple. Fitbit. All right, so Fitbit is one of my old silliness stocks that I hated back in the day. I actually am, believe it or not, long a little bit of Fitbit here. I like that breakout. I'm still long a bit. I didn't love the price action today, obviously, but there's really not that much. I mean, there's a little bit of resistance around 19s and 20s. But if you could get through there, believe it or not, the major breakdown took place in the 27s. So I don't know that it's going to necessarily go there, but they do have some cool new products out. I like that new one. I wish they had it with the HR. I have a Fitbit on, actually. I talked about when I bought this being the top of the stock. It wound up being true. I do like the new product, though. I just wish it had the heart rate monitor also. I guess I'll wait for the second gen. The new one, though, has text messaging alerts on it and stuff, and it's nice. It's run a little bit into earnings. If you do get a bit more of a spike up, I'd be looking to book some profits. I have some pretty, I guess, decent trade location on this, so I'm not in a rush to kind of hurry out of it. But if you were to start breaking back below, the last breakout here, which, well, it's already, I guess it's a little bit, yeah, it's run a bit. I was going to say 1575. But yeah, I mean that's kind of like I said, I have good trade location. I'm going to try and hold this one for a bit. If it sells off hard into earnings and gets back down to trend, maybe I'll kind of double up. We'll see. If it ramps and I get my move, I'll be out of it. I'm not a huge fan of Fitbit longer term, although I will say this: my health insurance and a few other ones are now giving step counters for free. The one I use, they didn't give Fitbit, but I do think Fitbit is sort of like the best of them, maybe, and these products are going to be folded in more and more into the norm. So I guess I'm still a little okay with the segment. The GoPro, I've hated that stock for a long time. I do think that their comparables are going to eventually, I think they'll eventually be a bit of a long trade in this stock, but I don't like it as much as sort of like Fitbit. I don't really love either one of them, the truth be told, but I like GoPro less because here's the question. How many people are jumping out of planes? How many people are riding down their bikes down a straight mountain slope? How many people will upgrade their already bought GoPro? I mean, once you buy a GoPro for $400 or $600 or however much they cost, why will you ever buy a second one? To me, the answer is you never will, unless you break it unless you land on it when you jump out of the plane. I don't like it because I think there's no upgrade cycle. There's no subsidies. It's not like an iPhone. I think the extreme sports enthusiasts are limited, and there are plenty of copy products now. I think it's really a commodity. I just don't see cameras being the next big thing. So I do think that they'll do better when the drones start coming out and stuff, and if you can buy this thing back down near the lows or at new lows, maybe, but I'm not a really huge fan of that one. The financials. So I talked about Credit Suisse and Deutsche Bank. They came into a little bit of resistance, and today they kind of backed off a bit. But I have amazing trade location on this one also, right when I talked about it, saying you have to assume that the kind of the higher or whatever double bottoms hold. So this is one, these are some stocks, believe it or not, I might even try and hold for years. Not necessarily just a little bit. I mean, of course, there's trade, I'll trade around the position or whatever, but I may try to hold it for a while. Let's see how this plays out. My thesis on this is very simple. It's basically wouldn't want to say a levered way of playing oil, but it kind of is. My thesis on this is that these stocks have come down for two reasons. One is negative interest rate policy, NERP, or ZERP, however you want to look at it. And secondly, a fear of their derivative books because they're overly exposed to commodities. As oil and commodities rise, that exposure and that default risk is minimized. The chances of write-downs are minimized. You have to like the stocks more. Stocks are trading at very low PE multiples, and unless you think that there is another Lehman moment coming, this is where you kind of got to buy them. They're hated, they're heavily shorted. They've been quietly rallying up, and there hasn't been, I don't think, I haven't put on the TV and heard about, a squeeze yet. When you put it on and everyone is upgrading them and loving them, that's when you sell the pants off of them. So that's my thesis with those. JP Morgan, someone asked about that. It's run a lot. You're getting close to a gap fill. Today you had a bit of a look into and fail in the gap. Doesn't surprise me that there's a little bit of pullback. The good news with JPM is on this leg, it's making higher lows and higher highs. I think it's still in a bit of a downtrend. There's a little bit more room up. I mean, I would be more of a BTD guy, buy the dip guy, than I would be a chase the rips here, particularly where we are in the range in the market. So yeah, that's my story with those. I had played Morgan Stanley, MS. Yeah, wow, that worked out nicely. I talked about this being an inverse head and shoulders, a potential cup and handle. Today was a bit of a topping tail. We're getting a little bit close to the channel high. Probably want to look to book profits on pops from now on, but this stock is trading 9 times earnings. I listened to all the TV guys say that the rally was not real, that it's all the trashy stocks rallying. JP Morgan and Morgan Stanley, these are not trashy companies or trashy stocks. If you can really get the banks to start participating, the breadth to expand of the rally, not just 4 stocks leading the entire market, Facebook, Amazon, Netflix, and Google, if you can start broadening it out and having some other stocks participate, the rally to me becomes a little bit more sustainable. I've said for a while I think Yellen was a game changer. It seems to me, and I'm not saying that there can't be pullbacks, there very well may be, there could be a very painful pullback coming, we'll see. But I don't necessarily know that the highs of the market are in. We're too close to the old all-time highs. We had we basically have a huge W pattern forming in the market here. You had the initial breakdown, the one with the flash crash. You rallied back up, you came back down, retested those lows several times, and now you're back up there again. You really shouldn't be back up there again if the market is going to be terrible. It's also very possible we're in just some big, large sideways range. I think a lot of people are bearish, though. I did a post today. I asked if we're going to see new highs in the market, and I think it was maybe almost close to 50-50 of people who thought we were going to, that the market is peaking. I think it was like 55-45 in favor of the bulls. I have to check that out. If you haven't taken that survey, find it on my Twitter stream at Justin Pulitzer and take it. You'll get the result tomorrow early. It just seems there are a lot of people who are still bearish, who aren't believing this, and this would be the most widely telegraphed top maybe that I've ever seen. Listen, I understand you have, we've had a huge move up. There could be a pullback. I've said it. I could even imagine there being some type of a gap fill, a move to retest the breakout, or believe it or not, and I know most technicians don't talk about this, although everyone thinks they're a technician these days. You could even pull back mid-range to the last breakout range and then bounce and still be bullish. That would still be into the 205, 206 area. Yeah, it's a big pullback from where the exact top, but it's in the big scheme of things from 181, it's not that big of a deal. It all matters on trade location. If you were chasing the stocks the last couple of days and chasing the breakout, you might not be rewarded. It just is how it is. Anyway, let's see. There were a couple of more I want to get through here, and we'll leave it at that. So Chipotle, it's weird. They had a bit of what looked like a professional gap. It had some continuation into the last range high, and now is giving it up, looking like it's going to fill the gap ahead of their number. Honestly, this is a coin toss now. I would not be messing around with it so much. I mean, it's looking a little, believe it or not, looking a little bit of head and shoulder issues. I would wait for this one. I think you'll either be able to catch a ton of people short and a squeeze higher, or it'll break down and you get finally a solid washout, and you'll get to buy it lower. You know, I've heard from people saying, with using social media metrics from like Foursquare, that this could be like anywhere but maybe a 30% comp store sales miss. If that happens, the stock's likely going to get the poleaxe, meaning get smashed. I know a lot of people are in this BABA chasing here. I want to just caution you. You have two or three distributions of stock up here. 181s to 182s, and the top of the end is 186s. You know, there's obviously, you know, listen, it had a multi-day consolidation up here above 79.68. If you're long, any close above 79.68 is still bullish. Anything that starts closing back into that range to me looks like a false breakout. We'll keep it simple. You know, yesterday was the breakout. Today was a consolidation day. Fine. If you're a day trader and you're playing very short term, over the 2-day highs is a right or right out long. If you're really late to the party, like you bought yesterday, you could use today's low as a stop, or anything below the 79.68. Keep it simple, stupid. That's my philosophy here. All right, I think we could end it there. I want to impart that, yes, we were a little bit, obviously we had a bit of a correction today, a little bit bearish, but the internals weren't all that crazy. I really want to see, and tomorrow will be a big test of the bull market here, or whatever, this leg, is to see how it handles a couple of really big down movers like Microsoft, Google, Visa, Starbucks. These are big, big stocks. I'm sure the rest of FANG is going to be under pressure. I'm sure Apple could be under pressure, although Apple kind of acts a little weird sometimes. It can be a bit of a counter, like everything will be down and then Apple will be up. It's like a relative safety play. I think a lot of that has to do with the buyback, although the buyback has to be on hold now because they're reporting. Let's see how FANG trades tomorrow, if the dip gets bought or if there's accelerated selling. And look at the two big names here. Facebook, like I want the takeaway to be that Facebook, if they nail Facebook and they chop it up ahead of their number, it sets up for what I affectionately refer to as the shake and bake. The run up, shake everyone out, comes down, and then they bake it back to the upside. I love that setup for Apple and for Facebook in particular. The problem we've had with Facebook is the last two times they've reported, they've been already up ginormous because of the Google numbers. So they ran, and then they ran a little bit more, and then people use that to sell it off. So let's see what happens if it does actually sell off a little bit before the number. Anyway, that's my story. I'm sticking to it. If you aren't following me, follow me on Twitter. That's my handle there. If you want to see this video again, or you missed some of it, or you want to rewatch it, or you came in late, or whatever, for whatever reason, you can see it on my YouTube channel, which is Justin Pulitzer Trades. Hit the subscribe button. You'll get notifications when I post new videos. Definitely want that. I post the rebroadcasts of these videos, the Periscope rebroadcast, the weekend review videos, and special edition videos on occasion. Anyhow, let's have a good rest of the week. Gap rules tomorrow morning, very key. Watch where the overnight low is in relation to the regular trading hours low, if it's a higher or lower, and then watch the opening 15-minute range. That is going to be huge. Cheers.